Okay, right. So this next bit here is quite an interesting area, and I don't even remember doing this when I was studying. When I say doing it, I don't remember understanding the reasoning behind it. I probably did it just for calculation, just knowing how to do it. But now that I guess older and I have responsibilities, it's something you think about, and it's something I recently just did. So I live in a flat, and I'm sort of Portsmouth way, and we recently extended our lease on the flat. In fact, as part of the so basically you would have, I think there's about 50 flats in sort of the complex, if you like, you can call it that. And I guess we're all joint owners of the freehold, if so to speak. So typically there is the owner of the land on which the flats are built, and then people just sort of take out the take out ownership of the flats, but then there's a leasehold. There are leaseholders, so you can have a lease on the flat, but someone actually my building of land is not very good. Someone actually owns the land, and those are the freeholders. So the whole idea is you're just leasing. Think of it like being on a farm. You're just leasing that until a period of time, and then literally that building will revert back to the owners. But technically, it typically is usually that the owners of the leaseholds are joint owners of the land. So we've just taken out an extension together, very busy, of for a 999 year. I think that's what it is. Not a 99. I think it was 999-year extension on the freehold, or sorry, on the leasehold. Although we are the owners of the freehold jointly, if that makes any sense. So the key point here is that this is 999 years is such a long time. So if I come to sell my flat, let's just say my little tiny flat here, sell my flat, it is really a capital transaction, right? I mean, it's a full-on capital transaction. I mean, it's an asset that I'm selling. The person who buys it knows that they'll be in there. They're not going to live for, I doubt it, they're not going to live for 999 years. So that's the fundamental point. Now, again, if you think about it, if you come and sell, if you're selling, if I'm selling this flat, and say for example I'm selling a building, or yeah, why not, let's sell a flat, and I sell my flat, and my flat has, say, 30 years left on the lease. um, you could argue that yes, this is a capital transaction, but 30 years isn't beginning to look like a long time. I mean, if I sold you a space for a year, and I'm calling it, I said I sold you a space. Listen to the language there. You're only allowed to be there for a year. You would say to me, Wayne, that's not really a capital expense, a capital transaction. That's just rent. You just leased your place to me for a year. So you can see that as I move from 999 closer down to 1 year, it's looking less like capital, and more like income, as in just rental income. And the thing is, for tax purposes, there's a very clear difference about the way we tax rental income versus the way we tax gain on the sale of assets. Which we saw that earlier on when we talked about, when we saw the loans with the bonds with the interest. And so the question is, well, what is that benchmark? And that benchmark is 50 years. So generally, all leases that are greater than 50 years are considered, I mean, I guess this is the rule. Like, they had to come up with something. All leases greater than 50 years are considered to be purely capital transactions. So you have a flat, you sell it. If there's 60 years left on it, you sell it. Um, Whatever profits you make on it, it is a pure capital gain, and then that capital gain is then just treated as a capital gain with the normal exemptions and then taxed in that way. But if it is less than 50 years, it is considered that some of it actually is considered to be rental income. And HMRC want to trap that because, again, you can imagine the rental income has exposure at 20% or 40% or 45%, something definitely that capital gains, capital transactions do not have. I know we haven't treated it yet, but the most you will ever pay on a capital transaction is 20%. And this is after the exemptions. This is after the exemptions. You have exemptions of roughly about 12 grand, and then there's the actual, sorry, 28%. It's changed. 28%. That's the most you'll ever pay. 28%. Um, that's the moral. That's the initial point. That's the initial theory. The question here is, how do we figure out the rental element of this, which is what I'm about to show you. So, a premium, first of all, is a lump sum payment made by the tenant to the landlord in consideration for the granting of a lease. So typically, you might have someone take out a lease for think of a pub. Someone takes out a lease for 5 years or something along those lines. And yeah, so because it gives you 5 years to exclusively use this um, um, a shop or land or whatever it is for a period of time, if you like. And so it's considered, so for definition purposes, a short lease is a lease for a period of less than or equal to 50 years. Now, part of the premium received in respect of granting a short lease, again, like I said, is assessed on the landlord as property income um, in the tax year the lease is granted. In the tax year the lease is granted. So the question here is, how do we figure out what percentage of that is considered to be income? And so they give us a little formula. And I want to use this alternative formula, first of all, just to illustrate why I think this one is easier to remember in trying to work out the property income. You have to remember it. You're not given in the exam. So you see this one, premium times 51 minus n over 50. So I'm just going to give you, here we are, new slide, premium times 51 minus n over 50. Right, so, oops, sorry, I think this the, second, let me just go back to that. Yes, 51 minus n over 50. So I just want to highlight, imagine, I want to go be really extreme. Imagine that you took out you took out a lease for 1 year. So basically, when I say took out a lease for 1 year, you're only renting. I mean, I don't want to use the word rent. Let's just call it, let's be legal about it and say it's a lease for 1 year. Well, if you took out a lease for 1 year and you paid, I don't know, £15,000 for that 1 year, well, let's look at it. If n is equal to 1, 51 minus 1 over 50 is 50 over 50. So literally 100% of that premium is property income, as in rent. That's the point. The point is that the smaller the number of years, as n approaches, well, zero, so to speak, all of this premium is in effect rental income. As n, of course, approaches 51 or 50. So if I now said that actually we're at actually 50, if you like, if I said that 51, if you think about it, if once n is greater than, well, 50 or just over, if n was 51, then of course this would be zero. So all of that premium, none of that premium would be considered to be property income. All of it would be considered to be capital income. I mean, of course, if n is 50, then what you now have is a 50th of that premium to be property income. So you can see that a whole 49 over 50 of it is considered to be capital income. So what am I trying to do? I'm ultimately trying to split this income between property income and capital income. So I have property income over here and I have capital income over here. And depending on how long you're holding that lease for, it'll be classified either as capital or as property. And that's the point. So I recommend this one, where you take the figure that you have paid and then literally just plug in the number of years that you will have that lease for. And the landlord, I want to highlight it here, the landlord will show this full amount for the whole year. There's no apportioning over months or anything along those lines, or over whatever that premium is. There's no apportioning over the number of years or anything along those lines. All of it is recognized immediately as property income for the landlord. We will see that it's slightly treated differently for the tenant who had to pay that amount, because of course it wouldn't be fair for them to whack the whole amount. If you're taking out a lease for 5 years, that's considered to be the property income for 5 years. So from an accrual point of view, for the tenant, you need to divide that by 5. But for the landlord, you recognize all of it. HMRC wants you to recognize all of it immediately. So let's go here. And it's sort of the same thing here. It's 2%. So they create the tables. Your syllabus doesn't show you the tables. You don't need to, but there's a way you can see what the tables are, and see what that looks like. So let's look at this example. Here it says Rodney granted a 21-year lease to Charles on the 1st of July for a premium of 10,500. So he has paid 10,500 for a 21-year lease. So part of this lease, part of this 25,000, 10,500 will be capital. Part of it would be income. The question is, what bit is income? So just looking at it here, that's the 10,500 times 51 minus 21 over 50. So 6,300 of it is income, property income, and the rest of it is considered to be capital, right? So you would be, so this is for, of course, Rodney. He's receiving property income. He granted the lease. He's receiving. We're not talking about Charles right now. We're talking about Rodney, 6,300. Or you could do it this way, where you say 10,000 times 2% minus the lease, the lease that we're interested in, n minus 1. So it doesn't really matter how you do it. And that's really the point. So I would do please do TYU2, just to confirm knowledge. Again, it's just literally the same thing. It's 26,000 times 51 minus 18 over 50, and you'll get your answer, and you're there. TYU2. I earlier on I talked a lot about this idea of furnished holiday lettings. I said that we have a scenario here where you are setting up a business. Imagine, so you intend on setting up a business, call it a bed and breakfast if you like. It might be out in Cornwall or Devon or somewhere nice that way. You furnish the place. It's possible to let out buy to let without furnishing. Very possible. You have you if you if many of you might have not noticed that you can let out a place unfurnished, but because then it's just property. The person comes in, furnishes themselves, pay you rent. But with furnished holiday lettings, again, I like to think of bed and breakfasts or businesses that you just buy a flat, or sorry, buy a like a chalet and furnish it. People turn up there, different people turn up there on holiday, and so it's very much a trading business. It's almost seen as a trading business in effect. And so it doesn't suffer. We have to keep a statement of financial position. It will gain capital allowances. All the benefits of trading it will receive. The conditions, of course, are that it is fully furnished. It's on a commercial basis. It's available for commercial lettings for at least 210 days of the year. It is available. So it's available because you yourself might be using it. Why not? But it's available for 210 days. But then there is a condition of it being actually let for 105 days a year. I believe you have the opportunity of an average. Yes, so you have where a taxpayer owns more than one property, the 105-day test is satisfied if the average number of days is at least 105. So you can find an average based on that. And it's really not about, you can't really let it to the same person. The whole idea is that you don't have, because then it just becomes your normal buy to let. So the whole idea is that people are coming in and going out as you would expect for a typical business, a holiday business. Yeah. And so, I mean, 31 days really is the maximum that you can let it to one person, if you like. That's really the point. There are conditions. If you are going to let to someone for more than 31 days, then by the time you add up all those days, the total must not, for different persons, it mustn't be more than 155. So imagine you have 5 people who you're letting to for 31, more than 32 days. When you add up those individual people, it shouldn't be more than 155 days, is what they're saying. But this is all gentle text. You're not going to, no one's examining you on this type of knowledge. It's just being able to recognize clearly the differences between a buy-to-let and where with its own conditions, cash basis, as opposed to this furnished holiday lessons, which is a trading business, and therefore we treat everything like we would a normal business. So it's all accrued, standard behavior, dealing with things. It will, finance costs are fully deductible, P&M, plant and machinery. We will talk about this idea of a pension scheme, because there are rules as to what you can basically what relevant earnings or what earnings are can be considered when you're trying to build your pension pot. And trading profits, of course, are considered. So property income from the point of view of having a buy-to-let is not considered to be sort of relevant earnings, and we'll discuss the meaning of relevance when we do this. It's not considered to be relevant when it comes to deciding what is pension income. And yeah, so here we have here that on the accruals basis, capital allowance is available in respect of plant and machinery. Cash basis, a deduction is available for plant and machinery. So I mean, you can. There is the cash basis in general, but we typically will tend to use the accruals basis when dealing with this type of business because we're dealing with all the typical, if you like, the typical standard trading behavior. It's a proper business here. Yeah, so capital allowances are available. So this is you're tending to use capital allowances here under accruals basis. If there's a cash basis, well then of course it's the same system, if you like, under a paid basis for plant and machinery in terms of replacement costs. And all the typical reliefs are available, which is why I say that you will tend to do an accrual basis for this system. I'm 60 minutes over. I think this might be the last one, so I think I might be able to slip this in there. Oh, it is. Yes, excellent. And then finally, there is this business here of rent a room relief. So this is the third type of situation where you are renting out a room or rooms in your house. So your own house, you're renting out a room in your house. And HMRC sort of have a simple argument. Again, I mean, it's a room in your house. So if you have two rooms in your house, each room will take half of that 7,500. It's not 7,500 for each room. And this isn't abnormal. We have students who will come over to England and will just live in the room of a family. And they'll, and HMRC have a simple rule. If the income that you're receiving from this person is less than 7,500, we're not interested. That's the first point. So there's a 7,500 receipt limit. If it's less than 7,500 a year, which if you like, and it's the irony is, despite all inflation, they've not increased that. It's been 7,500 forever. It's 625 a month. If that's what you're receiving, no one's interested. You don't even need to highlight it. But if it is over 7,500, you have a couple of options. Either you literally say, okay, then listen, what I'm going to do is I'm literally going to say that what am I getting that's over 7,500? And you sort of say there's two ways of doing this. You sort of say, okay, you know what? I received 10,000. So I literally say 10,000 less that 7,500 benchmark, and that's what I tax. You have that option. It's up to you. You decide. So if you get 10,000, take that off this, and that's it. Or you just do it the normal way. You just treat it as normal, rental income, less expenses. So your ultimate goal is to do both methods to see which comes out with less profit, because that's what you will be recognizing, if you like, as your property income. Yes. So, you just want to see for yourself, do I just go through the process of keeping records and kind of going back to what we did for when we had the buy to let? Just well, it's just expenses, of course, just expenses, not the interest. You can't start charging interest here or any of that. It's literally just what expenses am I having to deal with, if you like, on a day-to-day basis of managing. So their washing and their food and whatever it is, or the upkeep of the room, things like that. And that's kind of it's really a question of deciding that once it crosses over the 7,500, see how far it is from that. You have that option, or you treat it just as normal and deal with that. Okay, great stuff. So I guess as usual, the next thing for you to please do is to jump into questions, throw yourself at it and let us. So you can see here, this is an example here. Marisol rents out a room in her house, annual rent of 8,050. So it is greater than 7,050. So what are my options? Do I sort of say 8,050 minus 7,500? I'm just going to do it right now. So if I want to be 8,050 minus 7,500, gives me 550. So she has, I'll just do it here. So you have 8,050 minus 7,500. And I have 550 versus, let's see what her other options are. Her other option is to say that household expenses are 450, none of which relate to capital. We can't allow capital in there. Or 8050 minus 450. And this is, yeah, this is pointless. 8050 minus 450. Oh, sorry, that must have been 400. One second, let me just check that to see if that was 450 a month. So easy to. All right, household expenses are 450. Interesting. All of that. That's not a lot for the year. Well, obviously it won't be clever of her to do it that way because 8050 is 7,600. So of course not. Of course she's going to go for. Of course she's going to go for this method. This will be the profit she's going to declare. She's not going to go with this method. I thought this would have been times 12. That would have made a bit more sense. So she's obviously going to go for this one, go for the 550 method. So she's going to go with that route. Cool. Great stuff. And that is the end of property. And please read these and do as many TYUs. And I will see you in January for chapter 5 on employment income. Have a good Christmas.